Hello and welcome to part 2 of the lecture for chapter 2. So in this chapter we're going to talk about, or in this portion of the chapter, we're going to talk about journal entries, so how we record transactions in an accounting system. So we use something called double entry accounting, which means that every transaction is going to affect at least two accounts. As an example, when we receive money by borrowing money from a bank, we'll increase cash and we'll increase our debt to the bank. So it affects those two accounts. So it could be more than two accounts, but it's going to be at least two. It's critical that every transaction, the debits, the dollar amount of the debits equal the dollar amount of the credits. Each transaction has to be in balance. And we need to follow the rules of debits and credits based on the type of account. So we record transactions in something called a journal, and the process is called journalizing. I'll show you an example in a minute, and each transaction is going to be represented by a journal entry. So the steps in journalizing transactions is to first read the description of the transaction and determine which of the 5 categories is being affected, or exactly 6 in this case. We have drawing accounts. So asset, liability, owner's equity, revenue, expense, or drawing accounts. So I would look at that and say, look at my dead clerk mnemonic and say, what each of these, is it going up or is it going down? So I determine if it goes up or down, and then I look to my chart to say, how do I record that increase or decrease, with a debit or with a credit, and then I record the journal entry. So we record on the journal, we record the date in those first 2 columns, and the month is always 3 letters abbreviated. And then we record first debits, and the debits are left justified under the description column, and then the amount goes in the debit column there. Then we record the credit portion, and notice we indent that 4 or 5 spaces, and then the dollar amount goes under the credit. And then we record a brief description of the transaction so that other people know what was behind this, or so that we can remember when we look at it months down the road. But you can see in this case here, our debits equal our credits for this transaction. So what's going on here? I can look at this journal entry and I can see that our supplies increased. That's an asset, so we record that with a debit. So, and cash is being credited, that's a decrease of an asset. So it appears here that we took some of our company's cash and we spent it to buy supplies. So here are some very common transactions that happen over and over again in business, and which accounts we debit and which we credit. This is a handy thing to look back to later. So when we receive cash for services provided, we do work for people and they give us money, we're going to debit cash, which increases cash, and we're going to credit fees earned, a type of revenue account, to increase that. When we provide services on account, the words on account mean that we're going to get paid later. So instead of debiting cash, we debit accounts receivable. We increase the amount of money that people owe us, and we increase revenue by crediting fees earned. When we receive cash later from people that we had billed earlier, so receiving cash on account, we'll increase cash by debiting it, and we'll credit accounts receivable to reduce it. When we purchase anything purchase an asset on account, we'll increase the asset account. That could be supplies, like the example we showed earlier. And if it's on account, that means we're going to pay money later. So we increase the liability, accounts payable. Anytime you see the word payable, that's going to signify that it's a liability. When we pay that liability later, we're going to decrease the liability by debiting it, and we'll decrease cash by crediting it. When we pay cash for an expense, say like salaries or advertising or something like that, we'll increase the asset or the expense account and decrease cash. When the owner puts money in to the company, we'll increase cash and increase the capital account. When the owner takes money out, we'll increase the drawing account with a debit, and we'll credit cash to reduce it. So once we finish all of the postings, so once we journalize the entries and post them, we'll have totals for each account, and we'll prepare a trial balance, which is a listing of all the accounts and their ending debit or credit balance. So we do this so that we can find errors before we move forward. stuff like that. We can find out if maybe debits don't equal credits or whatever the case is. So here's an example of an unadjusted trial balance. And the word unadjusted means that we haven't booked adjusting entries yet, which we'll talk about in the next couple of chapters. So you can see here I've got a listing of all the accounts for this company, and it starts with assets and then liabilities and then owner's equity and then revenue and then finally expenses. And we record the ending debit balance of each account, the ending credit balance of each account, and I can see that they both add up to $42,600. So my debits equal my credits in total. Notice the header at the top, the name of the company, what it is we're looking at, and the date at which these figures are relevant. So a couple of tricks for finding errors. So what do you do if you do the project or you record all the entries, you post them, and you record the ending balances, then what? What if they don't equal each other? Well, if the difference is divisible by 10, 100, 1,000, so forth, there could be an addition error that you've made. If difference between the debits and credits is divisible by 2, then you may have entered a debit as a credit or vice versa. Here's one that's kind of neat. So if the difference between the two is divisible by 9, like say the difference is 45 or 630 or 18, something like that, then most likely you've transposed 2 digits. So you can quickly compare your numbers and see where you may have transposed figures. And then you could look for an account balance that's been omitted completely. So it may be that the difference between the two is an account that you forgot to transfer. So some errors can exist in spite of having equal balances, debits equal credits. So there's some other things we want to look for that kind of don't pass the smell test. So as an example, office equipment is an asset. Assets have a normal debit balance. So what if our office equipment has a credit balance? Is it possible to have negative office equipment? No, of course it isn't. So there's some error that's gone on there. So before we go further in the process, we would stop and find that error and correct it. Likewise, accounts payable might have a debit balance. That wouldn't make sense either. Our liabilities can't be negative. Or we could have numbers that are just outside what appears reasonable. If we pay $1,000 a month for rent and we look and we've got a figure for $15,000 of rent expense, well, maybe something was recorded to an incorrect account, so we would look at that. So we would make a correcting entry in each of those cases and then repost and do a new trial balance and make sure that looks right before we move on. So that's the end of the lecture for Chapter 2. If you have any questions, please don't hesitate to reach out to me. Thank you.